Hello and welcome everybody to the channel. Today we are going to discover how to quickly screen for stocks that match our investment philosophy. If you're just beginning or still evolving your investment style, this video will help you along that journey. Sometimes when we start out investing, the sheer volume of available stocks out there can be overwhelming. And information is coming at us from all sorts of angles, from cable news, Twitter/X, and other YouTube channels. It can be enough to turn us off from stock picking altogether. Please, if you haven't already, hit that like button and subscribe to the channel. It really helps us grow, and it lets me know you want to be part of a community that likes to invest in quality businesses. That's why the first step is to understand why you're investing. When you start out, you don't need to have a specific goal in mind with all the steps laid out beforehand. You'll just spend time planning rather than taking action. But you do need to have an idea of what you want to achieve. The specifics will come in time as you refine your strategy. Are you looking to boost your income, save for retirement, financial freedom, all the above and more? It's important to know what direction you want to go because that will inform the types of stocks you want to buy. Someone looking for quick gains won't be helped much by a stock like Procter & Gamble, ticker PG, for example, but someone looking to build passive income will. Procter & Gamble grows at a snail's pace, but does pay out a pretty handsome dividend. Next, you want to kind of think about your investment strategy overall. For me, it's very simple. I buy great businesses, I pay a fair price, and then I hold them forever. This strategy is very simple, and it's pretty much borrowed from one of my favorite super investors, Terry Smith. He's an investor in the UK, and I just really like his strategy and find his ideas very simple and easy to understand, and they match up with my own temperament. Next, you must understand your limitations. Warren Buffett calls this knowing your circle of competence. Investing in businesses that you do not understand is a recipe for anxiety and large losses. Trust me on that. I have learned that the hard way. It's not fun watching your balance dwindle every day. So know what you know. Personally, I like simplicity. Companies that sell products or services needed on a regular basis or have recurring revenue model. It's easy to understand that company X will always sell more makeup because people run out and need more. Beauty never stops. Microsoft makes billions with their Office 365 and many other subscription services that they sell. You don't have to understand the technical details of software, just that it's a recurring revenue stream that costs Microsoft very little to maintain. Also, businesses where the economics of the future are very easy to understand. Payment services like Visa, for example, are so simple because they get paid every time someone swipes their card. Also, a vast majority of transactions are still done in cash, so there is a very bright future for Visa to convert those transactions to card transactions. A very predictable future. People always create waste that needs to be collected. Buy toothpaste and cleaning products, eat and drink. No matter what, those things will never disappear. And somebody needs to transport all those goods around the country from the manufacturer to the retailer. Rail is the fastest and most efficient form of freight transport. Is the business critical to our modern economy? Semiconductors are in virtually every device, computer, and electrical component out there. Our modern economy would grind to a halt without them. It's so vital to the US, we are banning sales of our most sensitive semiconductor tech to China so that America maintains its competitive edge. Essentially, I prefer to understand what is simple, predictable, and necessary. If something doesn't fall into that, I avoid it because I do not understand. I don't understand energy or banks or the entertainment industry. Energy is just way too cyclical, it's reliant on commodity prices, and impossible to predict the future because of our current push for alternative energy. I just don't know what tech will win. Banks are highly regulated and ultra sensitive to negative and unforeseen events. And who could have predicted Disney's downfall 5 years ago? I don't think they're going anywhere, but the industry is highly competitive and undergoing a paradigm shift as the way people consumed entertainment has changed drastically in the last few years. I have no idea how to understand that landscape, so I avoid it. Once you understand what you understand, it's good to categorize your stocks. I borrowed this idea from legendary Peter Lynch. I highly recommend his book, One Up on Wall Street. The three categories on the screen loosely align with his 3 of 5 categories. Dividend growth correlates with his stalwart or fast grower categories. Pure growth is his fast growers, and the dividend category is comparable to slow growers. I put my stocks into these categories, but you can categorize stocks that will reflect your own circle of competence. I don't understand things like turnarounds, Disney is a good example there, or asset plays, so I don't bother with them. For me, dividend growth are companies that yield a dividend of less than 2 to 2.5% and have a long future of above average growth ahead of them. Companies like Microsoft, Apple, or United Health Group. I view pure growth companies as leading players in their industry and do not pay a dividend because they are retaining their earnings to facilitate and maintain their current fast growth. Google and Amazon are two obvious examples here. Ulta has big plans for their beauty retail business. Dividend companies are large multinationals that have essentially saturated their markets and their fast growth days are behind them. However, they take those fat profits and rather than retain them to reinvest in the business, they pay them out to shareholders as dividends. These companies will grow revenues less than 10% per annum and pay dividend yields well above 2.5%. Classic examples here are Coca-Cola, Procter & Gamble, Johnson & Johnson. After understanding your desires in investing, now we set up our screener. You can set up whatever metrics are most important for you. However, I'll quickly show you what I'm screening for. My primary criteria is where I enter specific cutoffs to limit the amount of stocks returned by the screener. I consider return on invested capital and free cash flow as the two most important metrics for evaluating a business in a quantitative manner. I set specific values here to weed out stocks not up to snuff. 15% for return on invested capital and free cash flow per share growth of at least 10%, for example. The secondary criteria are things I don't really set a limit on, but I include in what is returned from the screen because it lets me quickly evaluate the companies I screened a little bit further. I don't want to screen out a company with slow growing revenues or not currently buying back shares because they might have other qualities I value, such as a strong dividend. To me, a dividend stock adds stability to a portfolio with a lot of growth plays. So we come over here to the screening website that I like to use, and it is stockrover.com. And I am not affiliated with them in any way. However, I come in here, and when I get to set up my screen, you can notice that I have a bunch of different metrics that I like to look at. Like I mentioned before, return on invested capital, greater than 15%. Free cash flow per share, 10-year compound growth rate, greater than 8%. Free cash flow as a percent of sales, or free cash flow margin, greater than 10%. Gross profit, 10-year compound annual growth rate, greater than negative 3%. I set these metrics here right before I run my screen. This gives me a pretty robust list. This also tells me how many pass the screen. Right now there's 78 businesses returned from this particular screen I have set up. You can also see here I have a lot of different screens set up for what I like to look at. I won't go through all of these, but the important thing here is stockrover.com gives me a lot of flexibility in defining the criteria I like to look at. A lot of these metrics are custom built by myself, so they just give me that flexibility I'm looking for and trying to find the stocks that I feel comfortable owning in my portfolio. So once I have my screen built here, I can run it and we can see what the results are. So one of the things I like too about this website is I can filter or sort on various metrics here. Let's see if I can sort by the market cap. You can see here a lot of the big time players are returned: Apple, Microsoft, Google, Visa, and so on, Broadcom. I own a few of these. Of course, I don't own every single one of these, but I own a few of them. And
when I'm looking at this, I can just quickly assess what sorts of companies I like and what I don't like. Sorting on various metrics here, I can see, who's growing their free cash flow the fastest. I can take a look at who's repurchasing shares the fastest. So this gives me a very good idea of where to continue doing research, and once I'll pick out a few of these companies and I'll do a deep dive on them. So that wraps up the how to screen for a stock. The screening process is just the first step in finding great businesses. I hope you found this tutorial informative, and if so, let me know by hitting that like button and subscribe to the channel. Also, hit that notification bell so you can get notified as soon as I upload more great stock analysis content. Thank you and happy investing.